Thank you. Good morning. When I speak to members on a regular basis, I always preface my remarks with I am not an economist, and I'm very humbled to moderate this very esteemed panel. We have some prepared questions that are going to be assigned to some of the speakers, but we will have time at the end for questions from the audience. So as you're hearing them answer their questions, if you're thinking of questions, there will be plenty of time at the end. We are also videotaping this, and we will be putting it on the Members Home website. So if you want to go back, or if your colleagues couldn't be here today, you may want to direct them to it once it gets put on the website. In speaking to Dr. Connaughton prior to this morning getting started, he said he really would want to address and start his remarks addressing the gas price issue. We have a question about the gas prices, and it's toward the end, and I said I'm going to just jump ahead and go ahead and start with that question. So gas prices are killing us, and how are the ever-increasing gas prices impacting consumer confidence and spending?
Well, first of all, good morning. Can everybody hear me?
Yes.
Okay, great. I've been concerned about gas prices for about the last 4 to 6 months. And the problem with gas prices is, as everybody here knows, the recession was over in June of 2009. And for the first year of that, I asked people, I would continually go out and speak, and I asked them, well, you feel like the recession's over, and overwhelmingly I get the answer, no. And it was a very weak recovery. And it started to gain steam last summer. It really started to pick up, and we started actually begin to feel like there was a recovery underway. And certainly through the fall and winter, that was the case. But unfortunately, what's been happening in the past few months has been an escalation of gasoline prices in this country as oil prices have risen. And as a matter of fact, yesterday, the average price of gasoline in the United States was exactly $1 higher than it was a year ago. And so we've had that dollar increase in gasoline in about a year. And most of it's ramped up in the last 4 or 5 months. And you hear people talk about the possibility of people forecasting, and I don't forecast gas prices. I have no idea what they're going to be, but you hear people talk about the possibility gas could be easily $4 by July 4th, and maybe you've heard some people say as high as $5. I don't know whether that'll happen or not, but it certainly is scary. Why are gasoline prices scary? And why are they such an important part of the economy? You have to understand that in the short run, people live where they live, they work where they work, and they drive what they drive. And so their ability to respond to price increases is very, very limited. Basically, when it costs them $50 to fill their tank up, they pay it. When it costs them $75 to fill their tank up, they pay it. When it costs them $100, they pay it. The issue is that the amount of gasoline we use for transportation purposes, at 50 cents a gallon, every time gas goes up by 50 cents, it takes almost $85 to $90 billion out of pockets of consumers. When we include transportation and stationary uses of petroleum, it's almost $150 billion out of the pockets of consumers every time you have a 50-cent increase. So in the past year, basically, we've taken almost $300 billion out of the pockets of consumers. And unlike price changes in other industries, where it simply changes where you spend money, this is a situation where about 2/3 of this money, 100 billion of the 150 billion, or 200 billion of the 300 billion, actually flows outside of the country. It goes to either Canada, Mexico, or Venezuela, because that's where we buy most of our gas and petroleum. To give you a perspective on what $200 billion is in terms of the size, it's over 1% of GDP. But more importantly, in 2008, in the spring of 2008, and because of the impending recession that was taking place at that time, the Bush administration put forward a stimulus package and sent everybody back a check for $600 or $1,200, depending on your marital status and your income level. The package cost for that was $160 billion, and it took a recession that had negative first quarter of 2008 and actually had a positive second quarter. We didn't know how bad things were going to be, so we got the checks and we did what we're supposed to do as good Americans. We spent it. Good job. And congratulations, and we all appreciate that, and as a result of that, you looked GDP up, and so we didn't have a negative quarter. Otherwise, we had 6 negative quarters in the recession instead of 5 and 6. So that's my concern. Every time gas goes up by 50 cents, it takes between $100 and $150 billion out of our pockets, and that has an impact. GDP in the fourth quarter was only up, it was released last Friday, it was only up by 1.8%. You can read into that. But for a 50-cent gas price, maybe it would have been up 2.8, maybe 3%. So you can see going forward why I get real concerned. At current levels, I don't think it's big enough to do anything to take the steam out of the recovery. But if it in fact winds up being $4.50 a gallon this summer, it could be more of a problem. And that's why, as we go forward, just when we started to see things turn around, this is an ominous cloud, if you will, on the horizon. It's a thing I'm concerned about more than anything else. It kind of overrides just about everything else we're talking about, because 6 months ago, if you asked me about the dreaded double dip, I'd say very low probability, very low probability. Today, the probability is higher. Maybe, I don't know where it is, it depends on where gas prices are.
Thank you. Mr. Mark, do you want to comment as well?
Sure. There's not much that John said I don't agree with. So let me did a very good job of explaining the impacts on consumers. So let me try and get a little bit more forward-looking. I won't forecast oil prices either. That is, if you look at futures markets, you get a flat line, so markets don't always going to move. The best guess is it's going to be about where it is, and that's not terribly useful in a lot of cases. And the reason is it's really hard to disentangle all the factors. So there's supply and demand factors. Supply, all this events in the Middle East, particularly Libya, production coming offline, and there's a risk premium built in that more substantial production will be brought offline. There's also demand factors. So we're not recovering at any sort of blistering pace, but some other countries around the world are, and they happen to be economies that are much more intensive in their use of energy resources. So demand's picking up there. There's actually an article in Wall Street today that going forward, we probably have an excess of refining capacity in the U.S. for some long period of time because our usage isn't picking up. If we're not as energy intensive. So it's really hard to factor in all that and get a good forecast. But it would seem that particularly high levels like we saw in 2008, where we are today, probably aren't sustainable over the long run. In other words, there will be some sort of supply response that will eventually, and/or demand reductions that will bring down the price. So it would tend to be transitory. The question then is, how long will this persist? Is it going to persist long enough that if there are other risk factors at play, that it might cause the economy to stay slow? And that's a hard read. My best guess would be this would be transitory, maybe sometime this summer. We finally get some break, or after the summer, I don't know. And then you would have the reverse case where if prices are falling, it's as if the tax increase that came about effectively because of the rise in gas prices, because it goes outside the country, becomes a tax rebate. You get a little bit of boost somewhere down the line from gas prices actually falling. So my best guess is it would be transitory, and we won't be seeing this from this point forward.
Thanks. Bringing things back a little bit closer to home, talking about the Charlotte region economy, Dr. Covington and Bob Morgan, what are your thoughts on what sectors will emerge and what sectors will lag behind?
Well, thank you for the opportunity to be with you this morning. And Ray, I want to thank you for being such a great partner to the Charlotte Chamber of Commerce for a long time. And Karen Lindsay, I don't know if she's in the room. I think I want to thank her for the opportunity to be here. When she called, I told her that I was hoping to get an invite to play in the Pro Am today. So I will bail on her in a New York minute. But I tell you, I'm less than thrilled to be here instead of Hollow Club. I hope you will forgive me for that. If you go back to before the downturn, we were operating off of some research that showed that the Charlotte economy was driven primarily by 3 sectors. Banking, we all know that Charlotte had grown in the previous decade to be the second largest banking center in the United States, behind New York, ahead of San Francisco, bringing more wealth into this economy than any other sector. We remain today the second largest banking center in the country, notwithstanding the loss of the Wachovia headquarters to Wells Fargo. We think we know that banking employs at least as many, maybe more people today than before the downturn, roughly 55,000 people in the regional economy. We know that the income level is different and it's less. A lot of the high-paying investment banking jobs are gone. Of course, the corporate headquarters jobs are gone. I think just as important as the jobs profile, but often overlooked, has been the impact of the loss of the dividend income. Public record, there's at least one individual in Charlotte who owns 32 million shares of Bank of America stock. If you do the math on that, the dividend was, I believe, $2.50 a share. That's $78 million of income. Here yesterday, gone today. Now, we don't know how many shares of those two bank stocks are held in Charlotte, but it's something well beyond 32 million when you consider all the employees, the retirees, the investors, and others. And I think it was a red letter day for Charlotte's economy when those dividends went away. It will be a red letter day for our recovery when those dividends come back. They likely won't come back at the same level, but we need that income back in our economy. But again, we're still the second largest banking center. We continue to attract firms in the financial services sector. We knew going into this economy that transportation and distribution remain our second leading cluster, if you will, driving the economy. Not much has changed there. Charlotte is a distribution and transportation hub, and we will continue to see that. Manufacturing played a lead role before the downturn. Yes, we employ fewer people in manufacturing than we did 3 years ago or 10 years ago, but we're manufacturing more stuff than we did before. So those are the three sectors that were driving our economy going into the downturn. We had begun to see over the previous decade tourism begin to grow. Tourism has taken it right smack in the teeth because of the downturn and is still struggling to find its footing. It's great to have the Democrat National Convention coming back. Yes, it's a one-week event, one-time event, but if you're in the hospitality and tourism business, it is about the biggest you're going to get. And it's going to be business not just a week of, but in 18 months leading up to that. We had emerged and had begun to see healthcare emerging over the past decade as not just a follower of the economy, but as a driver. If there are 55,000 banking jobs in the region, there's some 78,000 jobs in healthcare. Healthcare is where the growth is going to be the strongest. Going forward, we don't have a medical school here, which causes people not to think of us as a healthcare center, and yet we've got some of the best hospitals to be found anywhere in the country, a level of healthcare at a good, affordable cost that is something that we're able to sell to relocating companies. And we expect that industry to continue to grow. A direct, not the result of, but something that has happened since the downturn, almost immediately when the banking world was turned on its head, Jim Rogers of Duke Energy suggested that we have an opportunity to create Charlotte to become an emerging new energy capital in the United States. And in fact, we've seen companies like Siemens and Toshiba and Cologix, et cetera, add about 3,000 jobs over the last 3 years. We've seen Duke Energy, of course, begin the process of purchasing Progress Energy, which will make them the largest utility in the country. The energy sector employs 20 or so thousand people in the economy, and we expect to see that sector continue to grow. More generally speaking, it's not a defined cluster, but Charlotte continues to be attractive as a headquarters destination in addition to those other industries for a variety of reasons that Anne Marie I'll save until we get to some of our other questions. Thank you.
Great. Dr. Cronin, do you want to add anything to that?
The only thing I want to add is that, just to clarify the way this recession played out, I'm going to talk about some national numbers now. Similar statistics, ratios would apply to the North Carolina and the Charlotte region. Just to give you a sense of what happened and how we're recovering. We lost 8.7 million jobs nationally in this recession. 25 months of successive month after month after month after month decline in establishment employment. 8.7 million. Never, we don't have records here. almost half of those jobs were lost in manufacturing and construction. We always think of this as a financial recession, and certainly the root cause of why the recession was so severe was financial, and the shutdown, if you will, fall away in the financial services industry. But the people who that took it on the chin, if you will, were primarily blue-collar, middle-class workers in construction and manufacturing. And Bob made an interesting comment, and that is that, we're now producing more in our manufacturing industry locally, but we're doing it with fewer people. And that's really very, very important. We lost 2.2 million manufacturing jobs, almost 2 million construction jobs. For the most part, those jobs aren't coming back. Where we're gaining jobs, and we haven't been gaining that many, but we've a little over 1.5 million jobs have been added since we started to add jobs in January of 2010. Where we've been adding jobs is in business and professional services, health and educational services. Those are the two sectors that have gained the most jobs, nationally, in the state of North Carolina, and locally. The problem is, and I think you can see this right off the bat, the skill set of people who lost their jobs in manufacturing and construction is completely different from the skill set of where this economy is growing. And so while we are growing jobs, we're growing very, very slowly, we're going to have this mismatch, and it's a big gap. It's not a small gap. Okay? It's not like we're going to train manufacturing and construction workers to be retail sales associates or something like that. Where we're gaining jobs is in very technical areas of the economy. That's where the job growth is right now. And so I'm real concerned with our ability to deal with these 4.2 million displaced workers and whether or not they'll get to participate in this recovery as we go forward. It's going to be a long time, by the way, to get those 8.7 million jobs back. It's going to be several years from now before we get those jobs back. But they'll be mostly filled by people who probably weren't the ones that were most affected by the recession. So we're going to have this lingering bulk of people that doesn't seem to have any discussion right now. And we're not really talking about it. I think we need to focus on it and how we deal with it so that we, not so much that we deal, not just to deal with the people who lost their jobs and are having trouble finding jobs with their skill set, but also how we prevent this from happening the next time there's a recession 8-10 years down the road.
So pretty much you've answered this, and you started your comments earlier that we were all told the recession was over in June of 2009. Specifically for Charlotte and the Charlotte region and North Carolina, would you say that we are in a recovery right now?
Well, I think absolutely we're in a recovery. And the recovery was getting a lot of steam. I mean, I think a lot of us looked at the fall and the winter of 2010 and really started to see real signs of some solid economic growth and some, most importantly, some job growth. The first 3 months of this year, the job growth has been pretty good. Not stellar, but pretty good. So, January, February, March, job numbers were, pushing 200,000 net new jobs a month, which is a number that we can live with. It's not what we'd like to see. We'd like to see 300,000-400,000, but certainly much better than the average of 100,000 jobs during 2010. The real question is, we're kind of like, what was that old saying by Yogi Berra? When you come to the fork in the road, take it. We're at the fork in the road, and we're going to take one or the other, and one of them is a reasonable path. I mean, personally, I like Matt's assessment that the gas prices are transitory, and by the fall this will all be over. And if so, I think that this recovery will continue to continue, and it'll pick up steam in the fall. But if the alternative case is we could, and gas prices do remain high for a while, we could just have it bumping along here at 1.5%, 2.5% growth. And the problem with that is that if you're growing at somewhere in the neighborhood of 2%, you really don't need to hire anybody to increase your output, because we have productivity gains that are around 1.5% to 2% a year on average over the last decade. So it's likely that we can get increased production to meet the 1.5% to 2% growth in GDP without actually having to hire new people. So, and one more thing I'd like to say about Charlotte, and Bob touched on this, and I think it's really, really important for us to understand this. We haven't really started to add that many jobs back yet. We've lost in the region 80-some thousand jobs, and we probably got about 10,000 of those back, maybe 9,000 of them back so far. So we're doing the same kind of thing that the country is. The big difference is the pay levels of these jobs. We've lost a lot of really high-level jobs, and that pay 7 figures, and those jobs aren't coming back. So that's something that's really going to change tremendously. So, it's something that really changed the dynamic, if you will, of this economy going forward.
Mr. Martin, do you have a thought on whether we're in a recovery in the Charlotte region or North Carolina?
Sure, and John's covered a lot of this there too. So we are in recovery. I think it was alluded to earlier. Recovery, and some of this is differences in the way economists talk and the general public talks. Economists look for turning points in the business cycle. So saying a recession over means you found the bottom, you found the minimum. That doesn't mean things are healing. And I think when the public hears the recession's over, they're thinking, well, that should mean everything. That should be the time when everything's better. That's not the case. So recession over recovery has started. As John indicated, I think we're seeing some good job growth regionally. And I think the patterns that existed over the last couple of business cycles will eventually are re-emerging, and barring something that will throws the economy on filter, over the course of this year and certainly into next year, the typical patterns emerge, and that is wherever the U.S. growth rate is, you can add a little bit to get the North Carolina growth rate. And then within the state, this is North Carolina is basically a two-cylinder engine, Charlotte and the Triangle. Those are the areas that are the fastest growing in the state, and you would expect to see that again. Interestingly, in-migration, and this crowd would probably know this better than most, definitely slowed during the recession, but never stopped altogether. People want to really work in Charlotte, and that means that probably helps a lot. Because firms want to be, particularly if they want to live and work here as skilled workers, that helps with firm location decisions as well.
We'll start with Mr. Cross on the next question. In April 2011, Fortune magazine indicated that real estate is back. And we would love your thoughts on whether you think the real estate market is back, not just in Charlotte, but in North Carolina as well.
Well, Ann, first of all, thanks for having me here with this distinguished panel. Clearly, you've dropped the sales optimist in between the PhDs here. So I'll try to temper my comments a little bit.
I'm with you, John.
Yeah, I mean, I do. I do believe that it's back. Let me share a couple of facts with you, just my observations. So I think the one thing that's interesting are the comments that John said about some of the higher income bracket residents, that those jobs are gone. We are clearly seeing evidence that it's the first-time home buyer that's driving the majority of the purchase sales, pretty much just in Charlotte and also across the Carolinas. That has a lot of profound impacts on how we as a lender, approach that, and how even builders approach that. We've seen in particular that the building community has kind of redesigned their business plans to focus specifically on first-time home buyers. That's the group, that is the segment that we're beginning to see pull away and strip away with the highest growth. And I will tell you, Charlotte and North Carolina is still one of the better performing markets in the country, and specifically to purchase. Factor out all the refinance volume, just talk about purchase, which is really what this audience is interested in. We've seen substantial increases month over month in this first quarter at levels that we haven't seen in the preceding 2 years. Now, is it back to the 2006 historical levels? No. So I would caution everybody to say it is, essentially kind of the new normal. But let me share this one factor with you. Last year, according to the Home Builders Association in Charlotte, in 2010, the top 30 builders in Mecklenburg County logged over 1,600 permits for single-family detached homes. Now, that was valued at about $235 million. So still lots of opportunity out there. And I would say that what we're seeing on the mortgage side is that borrowers and families are still buying and borrowing for the same traditional reasons they have for many, many years. Relocating jobs here into the marketplace, expanding families, and moving. So those traditions are still there, and we see it embedded in the activity that's going on. So right now, we've got some optimism around the purchase market here in Charlotte.
Great. I'm actually going to skip ahead to Mr. Martin and ask if you have any comparisons of the current real estate market on a national level to North Carolina and Charlotte, both commercial and residential.
Yeah, regionally, when you look at residential, there was a clear, I think this has probably been true the last couple of cycles, but particularly in this last cycle, given the housing nature of the recession, The cycle started in those markets, the downturn that is, that were hottest and then cooled off quickly. So the first leg of the downturn in housing that prompted the recession was really a subprime-oriented downturn that was focused in just a few states. And we all know which markets these are by now. It's Florida, California, Nevada, Arizona. I think that's was well over half of the subprime foreclosures. Subprime was never a big deal in the Carolinas and here locally. So we sort of sat out that first part. And then in the second wave, when the recession really started to get bad, or even a little before that, you started to have steady drip of job losses. Then in 2008, the world fell apart. And obviously with that level of job loss, you had foreclosure activity tied to job loss. And that's what we're dealing with now. So that really drove the market regionally, and we're still dealing with that. And I think that suggests that we're probably still a little bit behind the national market in the recovery. With the national market, again, being heavily driven by these areas that went through the steepest downturn first. So they're building off of a very low base where they are. I'm encouraged to hear John say that he's seeing some increase in activity. He's at the front end of all that, so that's encouraging. We still have a ways to go on working through foreclosures, though, in residential real estate. Briefly on commercial, someone like Bob, probably better positioned than you might. We spend a lot of time talking about business leaders in all sorts of industries, and the sense I get from on the commercial real estate side is that we're at a turning point, and that cycle is probably more closely matched with the national cycle. Valuations seem to be stabilizing. Rents might even on the cusp of a turnaround, at least marginally higher perhaps. And so I think the signs there are good, and maybe with the help of the DNC coming, what we have seen outside our building for over 2 years now, the Park Tower, there's finally noise and activity going on here, and hopefully that's a sign of things to come.
Great. Dr. Brown, did you want to add anything to that?
Well, I was just going to make a comment, just to fill in a couple of spots on what Matt said. One of the things we all have to understand is housing market is very regional. There is no such thing as a national housing market. The darn stuff's immovable. And as a result of that, the supply is where it is. And it's not like anything else where you can move the inventory from one part of the country, from one market to another. You're stuck with it. So, and Matt was right in saying that the cycles have been different. I mean, I think the Northeast was really the first to get hit, but long before anybody was really paying any attention. Then the ones that you mentioned, and the ones that got hammered because of the subprimes, they were actually in better shape right now than the places like this that got hammered because of job losses. And we really did get hit in this state by job losses. I said 8.7 million nationally, over 300,000 in North Carolina, a little over 80,000 here in the Charlotte metro area. So those are a lot of incomes that couldn't pay for mortgages. And we are working through that inventory. And one of the issues that I'm most concerned with, I think we'll talk about this later, and that is this dragging on the foreclosing process. It's really stifling, if you will, the recovery. I mean, I think at some point in time we simply have to say, some costs are sunk. Let's get this stuff foreclosed, get banks out of the business of foreclosing and get them in the business of getting rid of the property, and doing the best we can to make everybody whole again. Hanging on is just making this process even longer. So that's something that, and I was very, very concerned as I heard that in South Carolina, apparently the Supreme Court put a moratorium on foreclosures in the state. That's not a good thing.
And we are going to talk a little bit more about foreclosures very shortly, but before we get to that, I do want to ask Mr. Cross what your thoughts are on the changes in lending practices, the tighter government controls, the low interest rate, and the impact it's had on the banking industry and the customers that it serves.
Boy, that's a lot. And I think the group in this room probably could share their thoughts with me on this particular topic. I think the big question is what hasn't changed? Or, so much has changed in the lending practices. There are significantly tighter restrictions from the agencies. The investor requirements for our loans are much more stringent, and it is clearly a full documentation environment. And what we find daily, and it's very interesting, is that the borrower who may have purchased a home even as little as 5 years ago that now may be relocating or moving and buying again. It is a completely different underwriting experience. And so part of our role and our partner's role is to educate them to what those new expectations should be. Many of the lenders are working diligently to create the systems and the processes to manage to those tighter controls, whether it's higher minimum credit scores, whether it's difference in the ratios, whatever those guidelines are. And that requires all lenders, including Bank of America, to train their associates, put the processes in place to be able to make sure that we can operationalize that. And when we do that, it inevitably results in longer processing times. So one of the biggest challenges we face in the industry is the time that it takes to successfully board an application, process a loan, underwrite it, bring it to closing. Those times have expanded with all of these changes, and that's made it a bit of a challenge out there, but everybody's in the industry is working through that. You folks here in this room, like I said, you experience that essentially on a daily basis, and it is a much, much different environment than what it's been in the past.
Well, I'm going to jump ahead to the question a couple ahead, that nationally, this economy has caused a lot of credit scores to go down, and are banks adjusting their lending practices to work with these folks who are really distressed borrowers?
What we're seeing happening is a couple of things. One is referring potential borrowers that are not ready today to credit counseling agencies to help them repair their credit and get them on the path to recovery so that they are ready to qualify in the future. There are certain local programs that are available, down payment assistance programs in different municipalities. They typically represent a fairly small percentage, though, of the total loans that are originated. FHA seems to be really the primary vehicle today that many of these borrowers that are challenged a little bit, they tend to leverage that particular vehicle to get into homes, and that's essentially the changes that we're seeing.
So do you think programs like HAPA, the Home Affordable Foreclosure Alternative Programs, are really helping homeowners and who are facing possible foreclosure details?
I do. I know that throughout the industry and inside of Bank of America, there have literally been thousands and thousands of homeowners over the last year since HAPA was actually established. I believe it was back in April of 2010. Over 75,000 homeowners, I believe, and the numbers keep rising that benefited from that program. But in the end, it doesn't work for everybody. And when it doesn't, that's where we fall into the next steps of short sales, distressed sales, and foreclosures.
Well, speaking of foreclosures, back to that topic, there's a lot of talk about the shadow foreclosure inventory, and I would like your thoughts on how many more years you think the real estate market will be impacted by the foreclosure and short sales market.
Wow. Just like these guys are able to forecast gas prices, I am not in a position to forecast that one. That one would be a challenge to do that. I do know that as an industry, we work very, very hard to try to work through it. It's a complex process. If you think about it, the lending industry wasn't faced with this a couple of years ago at these levels, right? So Bank of America, our competitors, everybody in the industry is able to build out the internal operations to be able to support short sales, foreclosures. I'll give you one stat. Just inside Bank of America, we today have over 3,000 associates staffed for the short sale process. Well, I can tell you that 2.5 years ago, that number was far less than 500. And so it's a completely new skill set. And what I actually see happening is we tend to move people between departments where it's needed to meet the demands of the customers. And right now, over the last year and a half, thousands and thousands of these associates have moved over there so that the bank can operationalize the support functions and the processes to be able to go in, manage short sales and foreclosures.
Mr. Martin, do you have any thoughts on the shadow foreclosure market?
Yeah, this is another difficult forecasting task, but I think you can lay out sort of some of the parameters around it. So we've got a pretty good grasp. I can probably sit here and come up with a pretty good number on properties that are likely to go into foreclosure for this before we get a number on that. Because we know sort of what's in the pipeline hasn't yet been brought to market in the foreclosure process. So we have a good reading through the mortgage bank Association is on those that are late, seriously delinquent, the 90-day plus. And that sort of shadow inventory of foreclosures is probably about as many as the current run rate for sales of existing homes. But the issue is, there's sort of, and John Connaughton alluded to this, there's sort of a speed limit for getting properties through the pipeline. One article in the Wall Street Journal just this morning, so I guess some of the issues around dealing with this and dealing with regulators and government about this, some of the banks have fired some of their law firms that are helping them on the foreclosure side, but there's only a limited supply of attorneys that are capable of, have that skill set. So that those kind of issues, these sort of getting associates lined up to deal with the properties, having all the systems in place means it's not going to resolve overnight. So we're probably going to have this issue for a couple of years to come, and before it really starts to work itself into the system.
Dr. Connaughton, do you want to add anything to that?
Just one kind of overriding, it doesn't really speak directly to the foreclosure issue, but back in 2000, remember that, we had about 63% of our families living in owner-occupied housing. Since that time, up to 2008, we ramped up that number through public policy. So it was pushing 68%. It had about 5%, and if you look at the slice of the pie, it went from 63 to 68, so the slice of the pie of people who are in owner-occupied housing increased dramatically. It was part of public policy to put more American families in homes that they own. And a lot of the trouble that the mortgage industry had was there was, and a lot of what now look like very short-sighted policies and programs that we had were all aimed at, basically trying to get this number of people in owner-occupied homes up. We're now in that readjustment period, so we went up, we're now going back down. I mean, at the end of the day, we'll probably have 63, 64% of families in owner-occupied homes. And that margin, that difference, 4 or 5%, whatever it is, translates into 5, 6 million homes that have to work through the pipeline. However they wind up working through the pipeline, whether it's through foreclosure, short sale, or just simply being sold and sold and sold as people move around, we're going to have to work through that inventory. So it's going to take a while to work through that inventory. And that's the biggest issue. That's kind of the overriding issue to all these other items that we're talking about, whether it's how long it's going to take us to work through the mortgages that are about to foreclose, and how fast can we foreclose, and how fast can we move these properties. We still have that problem where, we're going to have to grow into the existing stock that we have for quite some time. So even when things get back on a level keel, it's not going to be like 4, 5, and 6, 2004, 2005, 2006, when this industry was basically go-go, you work 24/7. It's going to be more like 2000, 2001, where, it's a smaller component, if you will, smaller size.
Well, clearly a component of our market is the interest rates, and currently we are still experiencing very low interest rates. Mr. Cross, how long do you think we can sustain these low rates?
So similar to the oil question, this is another dangerous one to answer. But here's the reality, right? Interest rates have been attractive and low for several years now. It's almost created a new normal. And so I think there's a large population of folks out there that believe somewhere between 4 to 5% seems to be the normal range in interest rates. Now, if you look at some of the facts, the NBA is predicting 30-year fixed at 5.2 by year end this year. NAR is offering similar numbers at about 5.3. So somewhere in that range is what they're talking about. But as we all know, and certainly my colleagues here know better than I do, so many things can influence those interest rates. It could be the oil prices. It could be a natural disaster. It could be an act of war. And it'll really depend on how investors and everybody else reacts to those potential threats. So interest rates are really dangerous to try to predict. But here's what we know. It's still a generational buying opportunity for borrowers because, quite frankly, interest rates are at historical lows. Pricing is good in the marketplace. And I think what's probably noteworthy is that it's dangerous for potential buyers to try to time the market. And I know we always talk to them about that, but just think about it, right? You may be waiting to look at a $200,000 house that may drop another $10,000 in price, But while you're waiting to do that, rates may creep up to the 5.5, 5.6 level above what's been forecasted and published. Now all of a sudden, yeah, you get the house for $10,000 less than what you thought, but your monthly payment is up $50 a month. And over the life of that loan, it will cost you almost $18,000. And so it really is, quite a dangerous game, I think. But the good news is, today they're still good and they're attractive. And I think that our challenge will be helping our customers and our borrowers when it does change, what that range looks like. Because think about it, you've got a large population, like I said earlier, that thinks that 4 to 5% is normal. They may not have even experienced back in the days when many of us in the room first owned a home with 13, 15, 17% interest rates. And so that's all they know. I'm looking at the faces here as I mention those numbers. And, it's very interesting to see how the perspective of our borrowers are, because we talk to them daily. And I can just tell you that they all try to time the market, they try to time the rates. And they're very, very focused on that. And I believe it creates some hesitation on the sidelines that is further, is further impacting maybe their willingness to make an offer on a property and move forward with it. So, to some extent, a little bit of movement in rates upward may actually have a positive effect on buyers, how they react. We've seen that before in the past, so it'll be interesting to see how that plays out for the rest of this year.
Dr. Coniston, I'm curious what you think would happen if the mortgage interest deduction was eliminated.
Before you talk about that, I want to get Matt's take on something.
Okay.
Because, seriously, because John mentioned the fact that people are trying to, wait for the price to drop another $10,000, something like that. I mean, the Fed is very actively trying to fight this deflation issue and the prospect of it. Is that right?
Well, so you got, especially toward the end of last year, overall prices, and that's what the Fed's got to be concerned with. We can't pick out oil prices or housing prices because the instrument we have through monetary policies is blunt. It affects overall prices. So there was concern the prices were too low, is why we embarked on a second round of asset purchases. One of the effects would be, since short-term rates were zero, you buy longer-term assets in an effort to keep those rates lower than they would otherwise be. As John Cross mentioned, a lot of other factors come into play. So long-term rates could still be higher even with that in line. I don't know if this will answer your question, but so going forward, the best we can do, it would be the best contribution we can make to your business, is to keep inflation low and stable. You mentioned 13% interest rates. The reason they were that high is because inflation was 10% at the time. So we don't want deflation. That can cause a very nasty spiral, particularly in lending markets with debt. People can't pay off debt because their income is falling, because their debt's fixed, if overall prices are falling. And so going forward, I think that's going to be the issue. We can contribute to stability by keeping an eye on inflation. We can't control oil prices directly, but we can make sure that they don't lead to higher inflation broadly across the economy.
Before we go back to Dr. Coniston, can you go ahead and address the issue of Fannie Mae and Freddie Mac and the role they play?
So this is in the context of reform and potential alternatives. This is a tough audience to talk to this about, and so I'm glad it's not the mortgage deduction question directly. That is a tough one. I benefit from that. So the homeownership rate issue, I think, illustrates the problem. What we want is a setup. We want whatever policy gets applied to this, reform, training, and Freddie, and set up the housing finance going forward. We want something that's sustainable, right? We don't want this situation where we're pushing an equilibrium level of homeownership beyond where it can sustain itself over time, because that means that contributes to the boom bust cycle. And then also, I think also on the financing side, we want to make sure that we have policies that help stabilize the financing side of this as well. So there are lots of proposals out there. I don't necessarily have a read on specifics, so I'll talk a little bit more generalities. One option would be, so the way we're set up now, through the mortgage deduction and other policies, we subsidize the taking on of debt. And over time, if you get in situations where debt becomes misaligned with the ability to repay, you're contributing to the instability in that market. It's probably worth considering proposals that are more aligned with subsidizing the development of equity. It's a longer, so there's a transition, there would be a transition issue there, and I don't know the answer to that. But it seems to me helping subsidize the development of equity is an important thing. I think the other aspect of this that needs to be expanded is really the use of financial literacy at the point of decision making when it comes to home ownership. I've got a background in financial literacy, and it's effective when it's delivered. Right now, most of the resources, a lot of resources are devoted to cleaning up the mess after the fact. It'd be better to do it on the front end, have homeowners go through programs. If it's first-time homeowners, that's the right crowd to get into programs that help make sure they're ready for homeownership before they actually take on the mortgage. And I'll mention that we've got groups around town that do this. One that I happen to be on the board of, Community Link, has a homeownership program for low to moderate income individuals. And throughout this whole crisis, they've got 94% of those that went through the program are still in homes. Foreclosure rate has been pretty low for the population that they're serving. Those are the kinds of things that would really help support homeownership going forward, and doing it the right, sustainable way.
Thank you.
So
Do you
you're
want to
in
address?
the interest then? Talk about the second cow in the room. This is clearly an issue. I'm not going to predict what's going to happen. I mean, there are a number of tax reform proposals that are out there, and several of them have the mortgage interest deduction right out there. What I want to suggest to you is it may not be as big an issue as you think it might be. And so let's take that and take a look at it. If you've got a $200,000 mortgage, okay, so we're talking about first-time home buyers and people at that end of the market. You get, in the first year, you're going to get 5% mortgage rate, you're going to get a $10,000 deduction. Okay? And it goes down every year as you pay off the mortgage. But remember, you get $11,000 as a standard deduction. When you throw in some property taxes and a few other things, you may get that up to $16,000, $17,000. So the effective deduction isn't $10,000, it may only be $5,000 or $6,000. Contrast that to someone who buys $1 million mortgage, where the mortgage deduction they're getting is $50,000. And so it may be that your industry may be better served by a higher standard deduction, which gives people more take-home pay, because you sell a lot more houses for $250,000 than you do for $1 million. And so it may be, in fact, in terms of take-home pay for those at the bottom end of the market and the entry-level of the market, they'll have more take-home pay and be able to see an ability to purchase or make that monthly payment if you have a higher standard deduction that comes in to compensate for the loss of the mortgage deduction. So a standard deduction of $15,000, $16,000, $17,000, something along those lines may work out better for the home industry, at least in that segment of the market. That's on one side. On the other side, I've got a concern that's bothered me for quite some time about this, and that is, if I buy a house and I make an interest payment, it is not an expense and therefore not deductible off my income. But if I buy an apartment and I use it for rental property, I do get that interest rate deduction, and nothing's going to change in that because that's an expense for, that's a business expense as a so-called company. And I thought about this for a while. I said, well, geez, what if I buy a 4-apartment building and live in one of those apartments? Well, if I do that and I set up a corporation or company to do that, I'm probably going to get the interest deduction from it. Whereas if I just bought the one condo at the end, I wouldn't get the interest deduction. So there's a fairness issue out here between apartments or rental units and home ownership units that also needs to be addressed. That's one side of the concern of me. It's what we call in economics, Matt, the horizontal equity issue. But and so it may not be as clear cut but I think at the end of the day, my guess is that we're probably going to see some kind of change in the deductibility of home mortgage. Whether it's an outright prohibition that's traded off for an increase in the standard deduction size, or whether it's a cap on it at some level. There's going to be a significant change in this going forward.
Thank you. We're going to shift gears and hear from Bob a little bit. Bob, in your earlier remarks, did suggest we have some strengths and weaknesses in our industries here. We keep hearing about high unemployment. Can you speak to not only, again, our region's strengths and weaknesses, but what is being done to retain and expand job growth here in the Charlotte region?
Leadership and investment. In economic development, leadership matters. We have a governor who, unlike her predecessor, and working in partnership with Keith Crisco, the Secretary of Commerce, loved nothing more than to pick up the phone and call CEOs and personally recruit them to North Carolina. She loved nothing more than to pick up the phone and call the governor of Georgia or South Carolina and commiserate how we've just taken another company from them. And she is very, very competitive and aggressive, and again, leadership matters. We have the apparatus in place. Site Selection Magazine continues to rank North Carolina the top destination for corporate relocations. Just this week, for the second year in a row, the Charlotte Chamber of Commerce Economic Development Team and the Charlotte Regional Partnership Team were named two of the top 10 economic development agencies in the country. Leadership matters. We have seen, notwithstanding the challenges that we've talked about in the economy, we've seen our largest corporate headquarters relocation in 25 years, with Electrolux last year moving 750 new jobs from Augusta, Georgia. Just last week, adding another 200 jobs, part of an R&D component, with an average salary in excess of $90,000 per. We saw Siemens last year announce the largest industrial expansion since 1978, 800 new jobs, $178 million investment, energy sector related. We continue to see a solid, steady book of business, if you will, of companies who are interested in coming to this region. We continue as a region to invest in our future and invest in our infrastructure. In the middle of this recession, we have opened the facilities of the Levine Cultural Campus, 3 new museums built on time, on budget, in the midst of the toughest recession that we've seen. We've seen the opening of the NASCAR Hall of Fame. Yes, it's challenged to meet its numbers, but what a great anchor for the landing of things like the DNC and other conventions. We've seen brands like the Ritz-Carlton come to Charlotte in the last 2 years. We've seen the Epicenter maybe struggling financially to perform, but if you're there on Thursday, Friday, or Saturday night at 10 or 11 o'clock, you can see what it's done to add to the nightlife and to give young people entertainment options that didn't exist. You could say the same about the North Carolina Music Factory, which has come online in the last 3 years. You can see activity. Yes, the construction and real estate market continues to be challenged. But folks, go out to Ballantyne. I'm starting to call Ballantyne Charlotte's Shanghai. They've built 4 speculative office buildings in the last 3 years, and in every case have been rewarded because they've had product that's been on the market at good rates, because the location and other components tend to work. They've been rewarded with a lineup of corporate headquarters and other tenants that most cities would die for. And this is just one sub-market here in this region. On the transportation front, 1 year ago, Jerry Orr opened the new 3rd parallel runway at the Charlotte Airport. Not a coincidence that U.S. Airways has since added additional domestic destinations, has added additional flights to Central America, daily direct service now to Rome, Italy, to Rio de Janeiro. We're the 20th largest city in the country. Our airport is the 7th or 8th busiest. It gives us a level of connectability. We've seen, again, Governor Perdue accelerate the completion of I-485. Dirt will be flying any day now. Accelerating about 5 years, the scheduled completion of those final 6 miles. I could go on and on with other investments that have been made, but we're fortunate today that we're living off decisions and investments that were made by people who came before us. Hopefully these investments that we've seen made are going to help us, are helping us currently, and will help us over the long run continue. Just one additional set of facts. Just last week, Thursday and Friday seemed to be the day for the world to visit Charlotte. We had the Costa Rican Minister of Tourism in town doing some advanced work for a soccer tournament that's going to take place in June We think we're going to get an office of the Costa Rican government in Charlotte. It'll be the first foreign-owned office in Charlotte. Not a big one, but it would be a great splash to add to our international draw. We had 2 companies from Germany who were in town scouting out locations for their businesses. We had people from Ireland and Germany in town as part of the Energy Summit conversation that took place on Friday. And on Thursday and Friday, we had 7 trade journalists in town, part of a national public relations campaign effort that the Charlotte Chamber, the Charlotte Center City Partners, and the Charlotte Regional Partnership have jointly undertaken to help generate additional good exposure for the opportunities that exist. What's attracting Charlotte? What causes any company to come? Every relocation is unique, but if you boil out one of the 3 most common themes, connectability and the airport, we're able to compete at a level larger than our size because of our good geographic location, our good interstate connections, good rail connections, and the airport. We have a cost of doing business that's 93% of the national average. That continues to matter. We have a workforce that is growing, it is young, it is capable of running businesses and making things. And those are the 3 most common factors that help us grow jobs.
Thanks. In light of all that optimism, we all know that our state budget is suffering. And is there any one thing in particular that is having the biggest impact on Charlotte? And how would you say that Charlotte really fares in comparison to our sister cities of Greensboro, Raleigh, and Asheville?
Raleigh, from an unemployment perspective, always outperforms Charlotte in large part because it's a state capital, large public sector employment, but also the pharmaceutical industry has not seen the kind of losses that we've seen. I have a theory about regions around the country. I'm not an economist, I'm not a demographer, but I think one of the legacies of this downturn is going to be that the number of regions in the country that come back is going to be smaller than it's been in the past. The Charlottes, the Raleigh-Durhams, the Austins, the Denvers. I think Charlotte's growth is going to resume soon at levels that we saw in the middle of the last decade, and that our growth is going to be very positive going forward. I get paid to say that, so take that with a grain of salt. I worry. Augusta, Georgia has lost Electrolux. It has lost Husqvarna. There are companies throughout the Carolinas and Virginia in small and medium-sized towns who are dying to figure out a way to get to Charlotte and to other places to take advantage of these amenities that we have. When you drive to the coast and you drive through these small and medium-sized towns, the tobacco's gone, the textiles are gone, the retail is boarded up. I don't know what's going to bring those communities back because their young people are leaving and coming to regions like the one that we're in. I worry at the state level and the state budget level, North Carolina has a reputation for being very progressive in our education. Our university system is considered one of the best. It is a competitive advantage. The state deals with the reality of its contracted revenue. Are we talking 10, 12, 15% cuts to the university system, and what impact will that have to our reputation across the country? Similarly, K through 12 and community college funding. What are the impact of those cuts going to be? Important that we understand North Carolina is going through it just like every other state, perhaps from a relative perspective. Our pain is not going to be that much greater than other states. I think that's the question going forward. Can we maintain our reputation as a state that values education while we manage to the budget that is the hand we're dealt, so to speak, without doing too much damage to that reputation?
Very good point. We're going to now ask each of the panelists to wrap up, give us some final thoughts, a minute each. If you have questions, I would ask you please come to the center mic as they're making their final comments. And we have about 20-25 minutes for questions from the audience. So, Dr. Klein, I'll just start with you.
Okay, number one, kind of at a macro level, kind of at that fork in the road, and it's going to be kind of tricky to predict what goes forward from here for the next 6 months, depending on, I think fuel prices are going to be very instrumental in determining how strong this recovery is going forward. We'll have a number that comes out on Friday. It'll be the job number for April. 8:30 morning, everybody go to www.bls.gov and check it out. If it's over 250,000, I would suspect that the $3.75 a gallon energy price, gasoline price right now is probably not going to be too devastating. And if we can keep it there, we'll probably muddle through the summer, and hopefully that'll be right, and gas prices may fall. They fall towards the second half of the year. Second thing I wanted to mention, really quick, because Bob kind of piqued my. If you think about this, Matt talked about the two-cylinder engine for the state economy with Charlotte and Raleigh. Well, ours has kind of been misfiring. I think we got a fouled injector or something now, for the last 2 years. But actually what's about to happen is that the engine's still going to run rough, but I think we're going to get our injectors clean, and Raleigh's going to have some problems going forward, because one of the reasons Raleigh has done well is because of the stimulus package, with all the money coming down the states to keep them afloat. And that money's gone on July 1st. That's why there's a $3.7 billion hole in the budget. And there are going to be fewer state employees as we go forward. And I think that's going to cause Raleigh to suffer a little bit of what we've suffered over the past couple of years. So we'll see a change in terms of which cylinder is running a little rough and which cylinder is running a little bit smoother going forward over the next year.
Thank you, Mr. Brown.
So, Ann, first of all, yes, I am optimistic, and I want to end on that note. I think we continue to see families purchase homes for those same traditional reasons that I talked about earlier, relocation. So, Bob, your work and the things that you're doing in the community here really helps to strengthen that. Marriages, families being expanded, so that really hasn't changed, right? And so those fundamentals still exist today in this market. Remember this, it's one of the best and strongest purchase markets around the entire country, and specifically within that, the builder community. So there are niches within the macro market that you can capitalize on as a realtor, and we wish you the best of luck, and go out there again.
Mr. Martin.
So I'll join the growing bandwagon here for a positive take on this. Given everything that's gone on, there's nothing that has really broken the U.S. economy's productive capability. And I would be very optimistic that if any place in the world can figure out all the risks and challenges, it's going to be us going forward. And so I think that's the baseline long-term sort of positive outlook. And then there's a statement that demographics is destiny. And I think it's particularly true for your industry. And if you want to be somewhere in this country, there aren't many places that you would do better than being in Charlotte, where I think in-migration and population growth are kind of the norm, at least for the foreseeable future. And so I'd be very positive about the future for the Charlotte area going forward. And then, just because we've been talking in vagaries, I don't know what the question is, but the answer is 7, just to give you a direct number that you can avoid, right? We've been avoiding forecasts and giving specific numbers.
Thank you.
The St. Bonaventure story. 15 years ago, 2 young college graduates from Buffalo, New York, came to the Charlotte Chamber. They said, Bob, Atlanta is hosting the Olympics. We're looking for the next up-and-coming Sun Belt city. They were a little more thoughtful about that question than I was when I graduated from college. Bottom line, 2 of them came to town. One became a recruiter for First Union, one for Royal Insurance. 3 years later, we did a story at the Chamber that they had created a pipeline of 25 fellow graduates, alum, brothers, sisters. We updated that story 5 years ago. More than 300 of them have come to town. I happened to play golf with some of the original guys who came as part of St. Bonaventure. I don't go to the driving range of the golf course, that I don't run into one of these St. Bonnie kids. I call them kids, so they're in their 40s now. They introduced me to the latest St. Bonaventure person who is from upstate New York. Happens to be that my mother's from the same rural community as where these kids, the original folks, grew up. They think they have died and gone to heaven by moving from upstate New York to Charlotte, North Carolina. All of the challenges that we have, and they are now, some of them have been here long enough, they're getting married. I mean, to meet someone from the Carolinas, no, she's from Rochester. And then here, their parents are retiring back home. They're sitting there shoveling snow in March and April. Their grandkids are being born in Charlotte. The parents are asking, what are we doing up here? They're starting to sell their homes and move to Charlotte. They think they've died and gone to heaven. We remain a destination, And I think that's Charlotte's future as far as we can see forward. Thank you for the opportunity to be here.
Thank you, Bob.